What I'm hearing from CFOs is very much that here in the US, people are reasonably optimistic coming out of the election. So we're seeing that in surveys, we're seeing it in interviews and conversations that sort of overall there is a lot of optimism about what this new administration will do. And so that is leading people at Bloomberg and elsewhere to sort of expect that Capex spending will go up a little bit compared to last year's levels. So for the S&P 500, the expectation is about 1.1 trillion, which is in excess of what we saw last year and also the year before. Of course, that business optimism is driving it, but then also we're seeing other drivers like, for example, artificial intelligence, which is resulting in a lot of spending by large US corporates. Of course, as we will hear in a bit, it is tricky for companies and CFOs to make these decisions because they don't have a crystal ball and they don't necessarily know what's going to happen, especially also as they're navigating the Trump administration that has already sort of started some policy initiatives and then didn't follow through on it. So, of course, that makes life much, much more complicated for CFOs around the world.
Yeah, Nina, actually, let's hear directly from a chief financial officer. Nina, you're sticking around. We want to bring in Tim Arndt. He's a CFO at real estate investment trust Prologis. Tim, good to have you with us. As Nina was just telling us, especially when it comes to trying to understand President Trump's policies, when you're doing business globally and you have invested heavily on, say, nearshoring trends, I know that you have facilities in Mexico and business there. How does that affect your decision right now in where to put more money?
Well, thanks for having me. And, just to step a moment back on Prologis, we are the world's largest owner of logistics and warehouse facilities. We have 1.3 billion square feet around the globe in 20 different countries. And with regard to the question that you're asking here, interestingly, our investment strategy is not really around nearshoring whatsoever. Actually, what we've done is we've built a portfolio that's focused on the consumption centers, the largest consumption markets around the globe, leaving us a bit more agnostic to where goods are ultimately manufactured and produced. And in that regard, we're certainly watching the turbulence of some of these policies, but we expect the demand for our product to remain pretty steady.
A lot of optimism on artificial intelligence and, of course, building out the logistics and the infrastructure for that. But when you have potentially lower cost models coming up, could this be an issue that you're perhaps factoring in now?
Well, as for Prologis, our involvement in AI is principally through some data center development and conversion activity that we've been embarking on. Even though we're historically a warehouse and distribution facility owner and operator, we certainly have it being the case that many of our facilities are suited for higher and better use conversion into data centers. So we've been investing in that. We've built a large team around it. We've been very active over the last 2 years, have a number of projects coming out of the ground right now. But we do it all on a build-to-suit basis, that is securing leases with these largest hyperscalers. And so long as that demand is good, we'll keep up the conversion activity.
Tim, just following up on that, I'm just wondering, can you talk a little bit about the view that you have into your clients' plans? So when you're making these Capex decisions, what's the time frame with which you're allocating, given that, of course, many of these build-outs not just take 1 year, but potentially more years than that?
Yeah, that's a good question. I mean, the typical warehouse facility takes maybe a year to construct when you go vertical, but you're actually planning for many years prior to that, preparing the land and getting your entitlements. And we are active in doing a lot of that front-end work today to be ready for demand as it surges. As we look into 2025, we do expect an uptick in demand, or as we call it, net absorption in our markets, really because we're seeing customers use some of the gray space that they had built through COVID, some of that availability. They're finding that they need to expand outside of their current footprints, and we're getting ready for that activity.
Just wondering, actually thinking about other uses of capital. We've talked about this before. I'm wondering how you're thinking about deal making. That's also one thing that people are optimistic when it comes to the Trump administration here in the US. I'm wondering what your thoughts are on potential M&A that Prologis could do.
Well, look, we have a track record that reflects we're very interested and happy to engage in M&A activity. We do it where targets can be synergistic to our portfolio and when there's a real value add for our shareholders. And that can be episodic. And of course, it's something that we watch all the time. Our principal mode of growth is really through development of new logistics facilities. And that's on the order of $3 to $5 billion per year. And then we also engage in a third-party acquisition form of deployment that may be between another $1 and $2 billion per year. So we're pretty active even without large-scale M&A.
Tim, how much of that activity is happening across Asia and perhaps even here in Japan, given that, of course, we have a very different rate environment than other advanced economies? We're tightening rates and sending them higher instead.
Yeah, it's funny. In logistics, our business, the demand is driven by various different factors. If I think about Japan, for example, as you cite, a big part of our business there has been around developing new facilities, really in the spirit of supply chain reconfiguration, modernizing logistics facilities that were decades old at this point. So that can be activity that we engage in and is value creating, pretty much agnostic to the rate environment, because we're really recycling capital at the end of the day, building assets at one yield and financing them with a cost of capital below that yield.
I'm just thinking about shareholder returns here at this point. Of course, that's also an important focus for our viewers. What are your thoughts on that for this year as we're thinking about 2025?
Well, as I think about the main driver of our growth in 2025 is really going to be renewing rents up to market levels. Something that has been present in logistics real estate for the last several years is there was a very sharp uptick in market rents through COVID. And because logistics leases tend to be 5 or 6 years in length, even though there's been some softness in leasing across the end of 23 and 24, there's still very significant rental rate uptick for Prologis that's still present for us here in 2025. For example, last year in 2024, we renewed the lease rates on our rolling leases by 70%. We won't be quite at that level here in 2025, but there's still going to be meaningful cash flow growth.